What's up, Investor Nation? The boys are back, well rested after taking December off. As you guys can see, I'm not the esteemed co-host Tina Elmer. The boys are back. So we're going to kick off our market report, starting as we always do with a little bit of interest rate.
Yeah, so I'm looking at an uglier face now. I gotta back my girl Tina, but
100% big and red.
but to jump in here, so I'm sure everybody that follows the markets has seen sort of the headlines. There's a lot going on this past week. You have the World Economic Forum in Davos, where the world's elite come together and hang out. We've seen Trump throw more tariffs into the realm of possibility. The whole Greenland situation, where he came on strong and then kind of pulled back and said he wasn't going to use force. Everybody calmed down. We've had that whole thing. We've had a sell-off in the Japanese bond market. So there's a lot of headlines to discuss. But what you've seen is kind of this uncertainty around what's going on cause longer duration yields to rise. And so if you look at the chart, the 10-year today is sitting around 4.25. This is up from 4.10, 4.11 at the end of the year. So the 10 years risen, 2 years stayed the same, and sort of that spread widening is makes sense when you think about sort of the uncertainty that's kind of started the year this January. And then moving on to sort of the Fed, last time, when me and Tina were talking, the market was pricing in 2 cuts for 2026. One was going to, one in March, one in July. That's been, now revised to looks like maybe just one in June. Almost 100% certainty of no cut at the next meeting on the 28th. We know Trump doesn't want that. We know Trump keeps hammering Powell to cut rates, but I think the Fed thinks that, based on the data they've seen, that the economy is actually pretty healthy and stable, and I think the market kind of agrees, and that's I think why they're forecasting maybe only one cut in 2026, but.
Right, we'll wrap that up and then maybe move into a little how that's going to affect our DSCR pricing. I know everybody's, wants rate cuts, watching the tea leaves, hoping for these DSCR rates to come in.
Yeah. So I think as it relates to the Fed, you've got basically no cuts until June, which makes sense. We've got the Jerome Powell's term will end in May, I believe is the date. So you got May. He's going to sit on his hands until he's done. So no more cuts, at least the market's projecting, unless something happens. And then it looks like, Kevin Hassett seems to be I guess if you look at the betting pools or the betting odds, he's going to be he's at least the leading candidate. Feels like he's clearly come from more the Republican kind of side and upbringing. Seems like a very, has had stints at Penn, and I think he's currently heavily involved with Columbia as well as some other research institutes. And so it feels like he's a pretty strong candidate, currently within the, without any curveballs that get thrown in. As it relates to DSCR pricing, we had some favorable news coming out of, and we thought, I think the 30-year fixed mortgage rate that comes out from Fannie and Freddie, it hit 5.99 for a second, low sixes, and now we're probably back into the 6.2 range, I think is about where it is, 6.2. So you had some quick knee jerks. Again, I think we're stuck in this range for folks that are looking for DSCR rates, longer duration, 30-year fixed type of stuff. You're still kind of stuck in this range. When you see those pullbacks, that's probably that's why I think planning, if I'm running my book, I'm looking, all right, if I've got 10 deals I got to refinance this year, if you see pullbacks like that, you start to hop on some of those opportunities, because we had pretty stronger pricing out there for a couple days. And so you try and hit those stronger price points when these things do happen.
That makes sense. So Fed dual mandate moving right along to unemployment and inflation. JD.
Yeah, I think this kind of further outlines why Powell's going to sit on his hands. When you look at unemployment, It actually came down a tick month over month. Inflation right in line with expectations and no change month over month. And then GDP actually coming in pretty strong at 4.4%, which beat expectations and was up quarter over quarter. GDP kind of showing that the tariff talks from last spring, maybe didn't really have an effect. So I think, yeah, like to Brian's point, Powell's sitting there until May. If we keep sort of getting stable economic data like this, I think it's certain that there won't be probably a cut. But I think what's interesting is like when you look at this data, it's all pointing to a very healthy economy. But then you look at like consumer sentiment is really down. I think housing unaffordability is a big reason for that. But I think it's an interesting dichotomy because you get stock market highs, it feels like every other week. I don't know, Brian, you have any thoughts on sort of why consumer sentiment is so
strong? Or
I think it's down, yeah.
Sentiment is down from
affordability.
Yeah, I think affordability.
Across the board. I think we've been talking about this for a long time, right? You're going to have a 5-7 year window for wages here to catch up. We're 2 years into that, right? And so that wage gap and that inflation price of goods has to converse and come together and tighten, and that has not happened. And that's a slow trickle down effect that people are gonna feel for some time, unfortunately. Yeah. I don't know.
That makes sense. Yeah, I think that's probably right. That seems to be the key theme that gets pushed out from the headlines is affordability.
All right. Go ahead.
So flip to the next chart. I thought maybe I'd take some of this on the.
Let me frame this though a little bit. So you got Japan, right? We said we got a big electoral issue over there, right? You got a new politician, big spender, large stimulus. Those are going to be the issues, right? So long-term debt issues potentially in Japan, potential inflation risk. They're also one of the largest treasury holders. Right, so a lot of moving pieces as it relates to Japan. So, Brian, maybe frame that for the team on what happened to their yields, why they widened, and then how that affects yields in Europe and then obviously the U.S.
Absolutely. So I think what we wanted to point this data out because I feel like rates moved higher. They moved higher. There was a few days earlier this week. And it feels like the headlines didn't actually pick up on this. At least the news cycles, what was getting pushed out, didn't actually pick up on this, and kind of were glossing over it and calling it maybe its concern is about what's going on with Greenland and easier things maybe to click on.
Clickbait.
There you go. Yeah. And so we thought it'd be helpful to like bring some of this back into where we think. How the economies are tied together. What does it mean? We're all hoping for a good spring selling season for home builders. And so, when we see these types of moves and volatility is introduced, it takes you back a little bit. It sucks. So, but yeah, looking at this chart, look at this blue chart. We circled it. We didn't circle it in red. We circled it in green. We're trying not to use red as much, but and so we circled it in green, and it's like, all right, Japan spreads blew out on the long end part of their curve, and as you could see there, other U.S., U.K., other kind of treasury debt vehicles tied to these economies also moved higher, not to the degree, and so you've got. I'll highlight a couple key things that kind of if you look at that blue line, like just underline some of the movement, and then as Ryan mentioned, some of the fiscal stuff. And so you've got Japan. Japan was a super like accommodative economy from a rate like they were at zero rates for like at negative rates, zero rates. Like it was wild of how Japan was moving, how their rates were kind of pegged and that pegging, I think a lot of it is like if you look at their economy as a totality, you had such an aging, it's like one of the highest aging countries in the world where it's tough, it's tough, and so they've had to pump a lot of stimulus into their economy due to aging. And so you're starting to see that shift from a central bank policy towards zero rates, and then late in 2025, they took their rates up 75 basis points, their benchmark rates up to 75 basis points. You have inflation that's starting to finally manufacture itself in their economy, hitting above 2%. And then also in addition to this, and I think this is actually what drove a bunch of the that spike in rates, and we saw this in maybe like 2012, like 2012-ish in like Greece. A little bit was like concerns around the fiscal policies. And so the Prime Minister of Japan is in an election cycle. They introduced both tax cuts, more spending, and so you're seeing that lack of fiscal discipline get pushed in as concerns, and that pushes on our inflation, interest rates could rise, and so that's what's driving these rates higher. And so as a concern of that, so that introduces more volatility just general in the market. And it's also could front run. Japan is such a massive holder of U.S. Treasuries. I think it's like 1.2 trillion. Is that right?
Yeah.
Is that all right? 1.2 trillion of Treasuries is like if they're not going to be generating as much income on their side from taxes and they're going to introduce more spending, they might need to sell Treasuries and invest those U.S. dollars back into their own economy. And so that's what that's largely I think what you're seeing here.
So the counterbalance to that is the 30-year, the 10-year, those longer duration yields in the U.S. could go higher to keep appetite and demand for potential treasuries, right, from Japan. Because when you unwind the yen carry trade with the hedge cost, if they can get higher yields on their currency in home, why would they pay the hedge cost when they can be at home and make the same yield? And so that's what's going to drive. That's what's going to drive some of that, I think, for the economist over here.
Yeah, from a chat in the coffee shop.
That's that is super interesting. Anything else we want to mention on that, JD? So I do think this largely got overlooked, right? And so people don't understand how this affects or could affect.
No, I think I think you nailed it. I think like people have heard that whole buzzword, the yen carry trade, probably in the news before, but like all the massive hedge funds, money managers, they would all, they'd all borrow, yen and then invest in the United States. So with that unraveling, Japanese debt becoming more attractive, given the low price, the high yield, ultimately will put upward pressure on rates, which nobody wants.
So I think in summary for everybody in the audience and for layman's like myself, like risk and uncertainty on the long end of the curve just causes, that's going to cause a risk premium to be higher. Investors want a higher yield. That's going to affect mortgage rates, guys. And so until we clear some of this uncertainty and risk, you're probably not seeing that 10-year move anywhere near where you want it to be to put rates in lower levels, to Brian's point earlier. Right. Is that a fair statement, guys?
Yeah, that's exactly right. So then it becomes, I think, like, can we get the spread between mortgage rates and treasuries tightened?
Here we go. Let's go.
Should we go there? Here we go. Here's our new headlines. The first one, right? So administration moves to ban big investors from buying single-family homes. This is largely, and Brian, go ahead and take the defunk on this, but this largely is meaningless to the market today. But tell them why.
Yeah. So you've got a series of headlines that came out. The first one, as Ryan mentioned, around like boxing out some of the BlackRocks of the world. And so, there's a lot of, the headline gets dropped. I think there'll be some debate on how to maybe institute some of this, like practically, as you think through some of the market, the mom and pop investors really drive the mom and pop, the folks that own less than 100 properties is by and large it's like 99% kind of thing. And so these institutions own like 1%. Yeah. And so, I think it's how much of it is signaling versus what can actually happen. Like you could, because the impact that this would have, if you're BlackRock and you've got now $1 to invest, you're probably gonna not. Why not? They're not gonna invest in this space until there's certainty. We know that through all of our good institutional relationships,
Yep.
and so
Yep.
when there's uncertainty, and so this will have an impact by just the mere fact of it being like the boogeyman that's out there, and so I think that bodes well for all the all the entrepreneurs out there that isn't the BlackRocks.
And by the way, for the REITs that are buying this stuff, they're just not going to buy in the open market. They're just standing up their own development companies to build their own inventory, right? Which is what you've seen with Invitation Homes in their recent earnings calls, and others are going to follow suit. And so they're going to drive their own inventory and manage their own ecosystem versus buying something off Zillow or and they've learned the hard way, right? They did the speculative approach of spot buying or infill buying, and now they're like, I want to control larger density, larger tracts for more efficiency, and so you're going to see that move and less of the open market buying.
I think they've also already like mentioned that like BTRs would be out of that mix, and so that's like that they're going to look to get. I think you're going to that natural gravitation towards scale is going to continue to happen, and like BTRs gives that ability.
By the way, the REITs are also shedding inventory. They're putting older housing stock back into the market and retrading with a better yield on cost for newer inventory. So they're actually helping put inventory into the market and starting to build newer vintage that has less CapEx.
Yep,
in the market.
The only other thing I think, just to be, I guess, devil's advocate a little bit, there are some markets where some of the big players own between 5 and 10%, like. You have Charlotte, Dallas, Houston, Phoenix, Nashville. So in some of those markets, I could see it, there may be a problem that the administration could address and help with. But I agree with you, like largely, this is a bit of a populist statement from Trump to get some support heading into, the midterms. So.
Now, the next one could have some teeth, depending on the outcome. So Trump calls on Fannie and Freddie to buy $200 billion in mortgage bonds, and there's a lot to unpack here. It's a bit complicated. So, JD, Brian, you guys want JD take game on?
Yeah. So Trump. So this kind of goes back to the conflict in my head a little bit between Trump and Powell. So I think Trump now knows Powell's going to sit on his hands until May when he's done. So if Trump can't get the Fed to do any sort of easing, I think this is a little bit of him taking matters into his own hands to get some liquidity injected into the market. So Trump he's calling on Fannie and Freddie to buy $200 billion in mortgage bonds. I saw that the head of sort of the National Housing Conference said this could result in a quarter drop in mortgage rates. So it does have some teeth. But I think like a point, the concern is that if this policy were to get mortgage rates to fall, increasing demand, but if supply stays constant, then it's not really going to help affordability because that's only going to drive home values up. But
but it could also buy. And Brian was teaching me this the other day. You talked a little bit about how it could push some bond buyers into the DSCR market, right?
Yeah, 100%. Yeah, this is. Yeah, I was going to take us there next. Is like, so what this does for. We had Paul on a few months ago, and I'll be on hopefully in March with us again to give an update. But like this concept, we got $200 billion being put out by the GSE, by Fannie and Freddie, the GSEs, as they take in that liquidity and market share. And that'll tighten up that mortgage spread between the 10-year and the 30-year fixed mortgages. That'll naturally tighten that up. That's going to naturally push more people over towards DSCR loans, maybe other credit-based assets. But it does force a natural tightening, which is positive for all of us. So that could be folks that maybe were only buying Fannie and Freddie bonds every month. Maybe they're now looking towards non-QM or DSCR loans as a deployment of capital because it's tough. Like Fannie and Freddie, not Franny, but Fannie. Fannie is going to, you don't want to compete against them because they're going to go, I'm buying it. They're irrespective of where the price is at. They're like kind of that robot approach. Yeah, no, they're just hitting the button, hitting the bid, hitting the bid, hitting the bid. And you're going to have folks that are going to go look at where that price of a Fannie Freddie bond is trading versus maybe a non-QM or a DSCR pool is trading, and they might allocate, or they're going to, allocate more capital to that space. So it definitely pushes competition, which is good for everybody out there.
Yep.
Into our space here.
Mechanically, what it means, more demand means higher prices, lower yields, correct?
Yep.
Mechanically, that's how that would affect
Mm-hmm.
and potentially help push mortgage rates into a better place. Assuming we can clear up some of this Greenland and Trump, please stop tweeting.
Yeah.
All right, the third one. White House plans to let Americans maybe tap into some of their long-term liquidity in their 401k. I actually don't know anything about this topic, so I'm going to kick this one over to one of you two gentlemen.
Yeah, this is again, it's just more headlines from the administration out there that they're trying to address this affordability issue. If you look at, there was like the National Realtors Association did like a survey of first-time home buyers, and like 20% of them had to use gift funds from relatives and friends.
Yep.
So it's really a big problem. This is just another potential policy, just kind of throwing the kitchen sink of ideas out there on ways that we could possibly address this. I know right now with like IRAs for first-time home buyers, you can take $10K penalty free on your first home purchase. So I think this is just trying to find creative ways to address this affordability issue.
Yeah, I think one of our analysts, your brother Ryan, was listening to D.R. Horton. I think 80% of their down payments were coming from a relative or a parent for new home purchases that came out in the earnings call, which was interesting.
I texted my parents. I was like, guys,
what do you got in your fork? Yeah.
Anything you want to add there, Brian? That's an interesting way to tap liquidity, right? Could be helpful. That actually could be helpful.
Yeah, that could help expedite this, they call it like the wealth transfer that's coming from the baby boomers down to maybe grandkids at this point, but yeah, it's clearly so like takeaways from this slide is the administration. I think if you heard a lot of the news cycle from December was like affordability was a talking point that everybody hit on, and this is probably the administration's way of really helping kind of address some of the affordability concerns specific to housing. And you're going to see a lot of these policies target that first-time home buyer and affordable housing, whatever that means in your market. But those are two areas that when you think about like your underwriting, you're deploying capital in, there's going to be policies and support that are going to continue to come out from the administration. That's going to do everything they can from kind of that federal level. We know zoning's a hang up. That's driven largely, I think, at the municipality, which is probably a lot more difficult. But if there's federal regulations, if there's federal things, they're going to be combing through what areas could have the biggest impact of either getting those first-time home buyers that affordable housing need kind of addressed.
That kind of leads us into our last side, which is this home builder index and kind of the sentiment of where the home building industry is.
Yeah. So we thought, like, what are the key things that we look at to, when we wake up in the morning, how do we feel about things? How do we feel about the economy? Do we, how's the market perceiving, this industry that we're all in? And we thought it would be helpful to show, you can see here on this chart, if we had a green circle around that right-hand side, you could see the administration, when they announced the $200 billion, when they've announced some of these policies, you saw the market, at least specific to home builders, pick up. It clearly moves up and down, but there was a clear reaction here. And so there is some building optimism from the home builders. Like, we've spoken to home builders recently where they're planning to increase starts. They're pretty bullish. It seems like they're pretty bullish on the first quarter, the spring, I should say, not the first quarter, but the spring cycle. And so home builders make money by delivering homes and having it, having their margins priced appropriately. There's, I'm sure, other factors, but by and large, they got two mandates, which is profitable, and then you got to deliver homes to make the money, actually make the money. And so this is a function of how the market's underwriting each one of the home builders and that bouncing up effect.
So why that $200 million actually took effect, just add a little bit to Brian's color, is all these home builders have incentive costs, right, to help homeowners meet an affordability component. And so they use incentives to drive down mortgage rates to put bodies in homes. And so that potential reduction in mortgage rates could help gross margins for builders which have largely degraded since the 22, 23 highs of COVID, right? And so that's important. I think and we had an opportunity to speak with the economist. You two did not, and we hopefully will have him on. But one of the things he alluded to when I was talking to him was that 25% of your cost of homes is actually in taxes and regulations. So that could be impact fees, that's your permits, that's your architectural costs, that's everything that leads up to building a house. And so one thing they're looking at a local level is, do they do a cost-benefit analysis to this, and how do they do it? So if we reduce that 25 to 15% and we took less of that income in as a municipality, but we built 150 more homes,
right,
where it created jobs, those dollars were circulated to jobs, employments, to school. What's that recirculation of money into that local municipality mean to them from a cost-benefit analysis? And so you are starting to see, this was particular for Chester County, you are starting to see some of this cost-benefit analysis to see if the Fed can actually move some tax policies to loosen up permitting and NIMBYism in some of these markets to potentially increase that supply. Because at the end of the day, that supply has to increase in addition to rates to come down in order for affordability to actually get in line.
Got it.
Which I thought was interesting.
Yeah. Wow.
Yes, I'll add one other thing to this slide, and I'd be interested your guys' take on it as well. When I was in Charlotte 2 weeks ago now. I was in Charlotte 2 weeks ago, and I had the chance to meet with a lot of realtors, wholesalers, investors, and it was clear reading the room. Everybody, I'm making less. My wholesaling transaction volume's down, my margins down. And so, they're like, I've got to had to trim my team out. I've had to get more efficient operationally. I think every aspect of, if you're attached to real estate, you've had to go through that declining, cleansing, declining margin, tightening environment. Definitely over definitely in 2025. And so this chart, like, you could see that pain in March and April and May and June and July. Yep. Like, there was a lot of pain from the home builders. There was concerns like, where do margins head from here? Where does, how many homes can they actually deliver in 2026 and 2027? And so as an industry in total, 2025 was a lot of margin compression and pain. That was from the lender side, the lenders, the real estate developers, the real estate owners. I think there's across the board a very kind of tightening of margins. You're just making less. Mm-hmm. And so, hopefully that pendulum starts to maybe balance out depending upon what you do and how you do it. Hopefully that pendulum starts to balance out a little bit. I don't know when, but whether it's 26 or 27.
The positive of that is we can get back to hopefully a normal market, right? Mm-hmm. Consistency and predictability is going to have an effect on liquidity in the market. You can predict your margins. You can predict your profit margin from a lending perspective. That's going to attract more capital. The uncertainty is tough for the industry. So you do want to see that. Although it's painful, we want to see that as an industry in order to get back to a place where liquidity flows well.
Mm-hmm. Hell yeah.
Or fluid.
Hell yeah.
Hell yeah.
All right, guys, let's open up to a little Q&A. As always, just before we get into Q&A, if you have a project, we'd love to underwrite it. I think you guys know how to find us on Instagram or at our website, ifundcities.com. Hit the Get Funding link, and one of our LOs in your market will get back to you. All right, first question. Where do macro rate moves actually matter for local investors? Underwriting leverage or exit timing, ?
So I think I'll answer this and see if you guys chime in if I'm actually hitting the mark. So I think there's a couple things that if I break this down into local, so you got macro rates that get set. And so think of U.S. Treasuries as your super macro rate that everything gets priced off of. And so everything's driven off of risk premium associated with that. And that does translate its way all the way down to different markets. So you might see different markets that are less liquid or have more volatility in their pricing. Could have, if they're a riskier market, like say the foreclosure laws are incredibly difficult, or the eviction laws are incredibly difficult to operate in, you would expect a premium to that. And so, let's just pick on Philadelphia. Why not? It's difficult, or maybe you've got like San Francisco or New York where it's difficult to evict somebody. As a real estate investor, when you're underwriting that, you assume that, let's say you assume 5% or 10% of your people go, you're gonna have to evict them at some point. And if you're in a state that doesn't have those strict of eviction laws, you might be able to get them out in 2 months, 3 months. If it takes 12 months or 18 months or whatever the timing is in that municipality to get them out, that costs you money. And so we would anticipate that you're underwriting that high. You should actually be underwriting that higher risk. We do look at it on our side, and sometimes it comes through as higher pricing or lower leverage or higher leverage on certain in certain areas that swing the other way. That's how I would think about it impacting you.
Yeah, to add on to that is in your products, right? So your actual market in which you're accessing. So if you're in affordable housing or it's a fully liquid product like a fix and flip at a lower price margin, that's where the risk premium is going to be a little bit less because there's more demand for that product. There's a bigger market to access. Your nichier products, your higher value products, like your luxury housing where you have less demand potentially, those are going to charge potentially lower rates, higher risk premium to get those financed. I think you got to pay attention to that as well.
That's a good point. Like Class C multifamily is like an area that is tough right now because of the supply coming on from A and Bs.
Yep.
Yeah. Okay.
100%. All right. We got another one.
How are builders you work with factoring in / underwriting inflation risk differently today than they were 2 years ago?
So I'll take this first. I think one thing that if you're an investor and you're a smaller investor, the one thing you have to be paying attention to is the affordability component. And so if you look at the big home builders, they're using anywhere from 6% to 10% to buy down rates to meet the consumer where they need to be from a price point to move inventory. I think if I'm a small developer, I'm paying attention to that in my underwriting, and I'm putting that as part of my underwriting where I never thought you never had to do that before. I think to compete today, you have to be paying attention to that for sure. In terms of tariffs at the big builder level, they've been able to lock in their supply chains, pretty far in advance and forward curves, and so they're not feeling the pricing potential pressures that a smaller developer without, pricing power would potentially feel. So if you're a small developer, I mean, you're probably feeling a little bit of that. And I'm not sure you can pass it all the way through to the consumer today, given where rates are and the cost. So I think that's all things you have to be, and that's what Brian was talking about. That's where your margins are going to erode today. And you got to be thinking about how fast can I turn my inventory and my dollars over versus how much margin am I making or profit margin per project.
Yeah. And specific to that inflation risk, some of the things we are seeing is depending upon how. So if you have to go vertical on a building today versus 2 years or 3 years from now, is that you are keeping, you are factoring in inflation to your vertical costs, your insurance, each one of those periods. but they're keeping the home price or the property price or the project price constant. There's not a lot of assumptions. We are seeing people not assume that they're going to get 3 points, 4 points in home appreciation.
Great point.
Yeah. When you're underwriting a deal. So hit your costs, which will help when you think about those longer duration projects.
All right, guys, no further questions. It was good to be back. The boys are excited. I think we have a hell of a lineup coming this year with great keynote speakers starting next month with big law firm that's going to speak through some of the legalities around real estate, followed by, a head of fixed income for Voya, and then followed by potentially a really well-known economist. So it should be a really good lineup the next 3 months. Tune in, and the capital markets boys will be back. See you later.